Okay, so good morning, everyone. Welcome to today's Fire Up training. Before we get started, just a few important notes. If you haven't already, make sure to check out our website. This is where you can find recordings of past Fire Up trainings, product information, and other helpful resources anytime, day or night. Since today's session is being recorded, please go ahead and turn off your cameras and keep your mics muted during the presentation. We'll have a Q&A at the end, so feel free to drop your questions in the chat as we go or hang on to them until that time. Don't forget to put our Fire Up trainings on your calendar for every Wednesday morning through March and attend as much as possible for a chance to win a Pit Boss Pallet Grill. Now, let's get to the reason that we're here this morning. We're excited to have Dan Johnson, our BDM of the North, and Kent Thiessen here available for us this morning. The topic of the Fire Up training today is navigating cash flow strategies during challenging times. So with that, I'm going to hand it over to Dan, our Newfields Ag BDM, to get us started.
Good morning, everyone. Thank you, Jamie. I think we're all set to roll. Thank you, everybody, for joining us for this little window of time. And really, it's an investment for all of us, right, in our business and what we do. Just wanted to make a couple comments here before we introduce our guests. But I really believe you're going to receive some really great value this morning in what we're going to be talking about, but we're going to be in a little different conversation. We hit a lot on our product portfolio and our differentiation of products in the marketplace and the technology. But this morning we've chosen to talk around navigating, again, cash flow strategies during challenging times. And clearly, this is an opportunity for us to engage with this conversation with Kent relative to, we know some of the challenging times we're in. How do we as professionals bring value to our growers? And Kent and I were talking just before you all joined us, but we really feel like in these tougher situations of economics, profitability, those types of things, it's really folks like yourself that are able to bring value, help growers work through problems and challenges, and ultimately be profitable and grow a healthy, profitable crop. With that, it's a pleasure to have Kent with us. I'm going to introduce Kent. Kent Thiessen is a farm management analysis with Green Solutions Group based in South Central Minnesota, which is where I'm from. He retired in 2023 after a 20-year career as Vice President and Chief Ag Loan Officer of Minstar Bank in Lake Crystal, Minnesota. Prior to that, Kent served as an extension educator in farm management and marketing with the University of Minnesota Extension Service. He has both a master's and a bachelor's degree in agriculture from the University of Minnesota. Kent writes a weekly column titled Focus on Ag. Kent will tell you a little bit about that, but I encourage you to subscribe to that. I do myself. It's a great weekly piece that'll be of value to you and your business in working with growers. So it's distributed to several Midwest ag publications and web sites, as well as a large weekly email list in addition to that. Ken is a frequent speaker on farm management topics, serves as a coordinator for the feature forums at FarmFest, which is a main ag farm show here out of Minnesota. So Kent, we appreciate your time this morning. Thank you for joining us, and we'll give you the microphone here to share with us.
Well, thank you, Dan, and welcome to everyone this morning. As Dan mentioned, I do write a weekly newsletter, blog, whatever you want to call it, called Focus on Ag. I feature a lot of farm management topics, including farm program analysis, land rental information, cash flow management, some of the things we're going to talk about today. My email address is up there, kenttc@gmail.com. Just shoot me an email. I don't charge for that, sending that out. It usually comes out on Monday mornings. I'll be glad to add anybody to that list. As was mentioned, I am working with a group after I retired from the bank. I connected with 4 other individuals in a group called Green Solutions. We kind of work independently, but we do have some folks that work in the area of real estate. We're kind of the folks that aren't looking for the big company, maybe not the big splashy sales, but the ones that want to maybe sell some land privately or family transfers, that type of thing. We also have a person that's in appraisal work, so certainly fits. One area that we found kind of unique is the equipment sales and appraisals business. We have a couple folks there that are really good in that. One guy is exceptional on farm machinery appraisals. He also has a lot of contacts, again, on if somebody is getting out of the business and doesn't want to have a big machinery auction, sell things piecemeal, and has a lot of used equipment. He has a lot of contacts, both knows people looking for equipment, or if you have people looking for equipment, he can probably find it. Also, again, we find people that need machinery appraisals, whether it's ag lenders, estate services, fits. My area is the farm management work. Besides that newsletter and doing a lot of speaking, I also work with a lot of land rental arrangements and contracts. Again, a lot of times folks don't want to hire an attorney or go through a land management service for a very reasonable fee. I can work through the arrangements with them and put together a simple contract. Also doing some independent farm financial analysis of government farm programs and crop insurance strategies. And I am available to do meetings, as was mentioned. If you ever have a grower group or anything, you want to have a meeting. I have the topic you're going to see today on cash flow, a little expanded version of that. I also have one that's more focused on just crop insurance and farm program decisions. It seems like government programs have become a big part of financial management on the farm. And it doesn't have to be an organized meeting. It can be just a group of growers. If you want to get them together to go through some strategies, we can work through that. Today, I thought I worked with Dan. We're going to focus on a little overview of what's happening in the agriculture, more specifically in crop agriculture, crop production. So we'll kind of focus through some things. I guess big picture, this was in September. USDA every 6 months comes out with their farm income forecasts. And the headliner on that one that caught a lot of the national headlines was that farm income was going to be up substantially. As you can see there, $180 billion, that's nationwide, from 139, and almost as high as we were back in 22. Now, the difference in 2022, we had very high crop prices. Corn, soybeans, almost all crops were at high prices, and which kind of brought that up. The difference in 2025, you see the blue bar there that says $42 billion. That's the amount of government payments expected to go to farmers this year. So you can see almost over 23% of that income is made up of government payments. And then if you took out cattle profits on top of that, that bar would be down, if it was just the crop part, more similar to what we had back in the 2017 to 2020 era. So it is a little, again, if this just shows here, if we drill down on the crop side, you can see the last 3 years, the green bar being 23, the orange bar 24, and the blue bar 25. The net income from crop receipts has been declining, and not corn and soybeans is the most dramatic, but it hasn't been good in almost any crop area as we look down the line there. This came out from American Farm Bureau here within the last 6 weeks. And their projection is, again, this is all crops, but if you go to the far right there, you can see it's 3 years again, and they're projecting On the average, this is all acres of corn in the United States, a loss of $153 an acre, about 83 on soybeans. Now, maybe the soybean one improved a little here with some price increase late in the year. But a lot of that was already built in. Most of that improvement, if it does come, would come in 26. But you can see it's not good in any crops out there. It isn't just corn and soybeans. And sugar beets aren't on here. I know we get up in Minnesota, and I know I had a visit with the executive director of the Sugar Beet Association, and they're talking losses of $100 to $200 an acre. In fact, in some areas where they had some disease issues and poor crop, even $250 to $300 an acre. So again, it's a pretty negative year. And again, it goes back to those government payments. This just shows by region, and you can see again, just another, this was from Ag Lenders when they surveyed them here about a month ago. And you can see if you go out to the far right in each of those bars, whether you look at about 50% nationwide, but it's below 50% in the Corn Belt and the Plains of crop producers, of ag borrowers that will be profitable. Again, this isn't crop producers, it's all ag borrowers, so it includes cattle producers. So it kind of points out again that we're going through some really challenging times here, certainly equal to what we did about a decade ago, but also maybe even a little more severe in some cases. This shows, this is again from the University of Illinois, based on University of Minnesota FinBin data, shows the average profit margin in crop farms from 2019 to 24. And we don't have 25 on there, but 25 will be as low as 24, maybe lower. So you can see it may go into the negatives, but again, just pointing out the situation that we're kind of going through. The National Corn Growers did a survey here. This was done right before harvest, and they asked actual farmers, how concerned are you about the current farm economy? And you can see almost half, 49%, are very concerned, another 27% moderately concerned, and 16% somewhat concerned. So obviously the concern level out there by farmers is quite high. Now, again, maybe once harvest gets done, if depending on what they had for yields, a little improvement there with the China trade deal, maybe that optimism would be a little higher. But certainly, I do hear from a lot of farmers as well as ag lenders that the situation out there is real. They also, in that same survey, asked farmers what kind of changes are they thinking about. And the most obvious, the first one was over 58% is postpone equipment purchases. This is the time of the year we see a lot of farmers upgrade equipment. Certainly, all you have to do is drive down the road, the highway, and buy equipment dealers, and there's a lot of equipment on the lots there. And you talk to any of them, and it's not been a very good year. And certainly I hear that from a lot of farmers that have routinely traded combines or tractors where they're talking about maybe running the equipment an extra year or two. The second one, and this maybe gets more into an area where you folks work, is reducing fertilizer application. I guess I think there's an opportunity with maybe more efficient use. I get concerned about that one a little bit because sometimes you can make cuts that actually end up hurting you. If you reduce your certain inputs, and it cuts into your yield, you may be too far. It's certainly can create even more problems. But that's one that is certainly out there with the high fertilizer costs and increasing costs. The costs are almost back to their high back in 2022 in a lot of areas. The potential cash flow squeeze that we see coming, is it going to get better? We'll have to wait and see. Kind of drilling down a little bit on this. Again, This just shows, this came from Farm Bureau again, crop revenue compared to cost of production. And you can see we had some struggle years, like I said, back in that 2014 to 2019 era. Then 2020, we pumped a lot of government money in there, and we had 20, 21, 22, 23 were pretty good. And since then, we've really struggled out there. Actually, 22 was the last positive year, and so it's been a challenge out there. This is a little chart I put together, and I'm not going to go through all the numbers. I do want to point something out. The Minnesota corn growers asked me to put some data together that they could use with our state legislature, but they've also used this with the U.S. House Ag and Senate Ag Committee in Washington, D.C., and actually was part of the testimony that got used to come up with some of the aid packages. But basically, I looked at corn, and instead of just we hear break even cost, all that. Well, that can vary a lot. But what I did is I took average costs up until 25 and 26, where I'm using estimates that I get from various crop input suppliers, and looked at the direct costs, looked at the overhead costs, and average cash rent. This is on cash rented ground, and came up with how many bushels of corn at the average price or projected price would it take to cover those costs. This isn't any return to management or labor or profit or anything. And you can see when you get down there on the bottom line, even back when we were back in 2017, 18, 17, we got up to 215. Obviously, yield is a factor in there if you had a low yield year. But you can see we've really jumped up here in the last couple of years, where we're up in that 253 to around 250 bushels an acre. And I think I used a yield of 225. Yeah, 225. So that was the average yield. But at 225, we'd lose about $110 an acre. And if we went down to a 210 yield, which is probably more typical, it's for next year 153. But you can see there, it kind of points out, I think, that the dilemma we're in here with the input costs and the prices that we have. And so we maybe can't, unless we can make some adjustments there, yield our way out of this situation. This just shows the situation with prices, and you can see cotton is included in there with corn, soybeans, and wheat. But we've just been on a trend here. Now we've seen a little uptick in soybean prices, but it's still been a struggle. This is a projection that USDA put out. What they see is the 10-year baseline, and you can see they're kind of targeting that this is average farm level price, $10 soybeans, $4 corn. Now, that doesn't mean it'll be there. We see fluctuations. Right now, we're a little higher than that on corn or soybeans. But if you look back before the last 4 or 5 weeks, farm level prices in most areas were riding at that level or lower, and the same with corn. So hopefully they're wrong and we get back into better prices than that. And obviously there's a lot of fluctuation. That's where marketing plans and marketing comes in. Back to showing again what the listed costs are. This is from actual farm management data, so I don't have 25 in here, but it will be very similar to 24, if not a little higher. Might be a little lower if folks had a really good yield. But you can see we've been running right at that 450 mark. This is from 1,500 crop farmers in southern half of Minnesota. And you can see that's where the numbers are. I don't think it's that different wherever you go. I look at Illinois and Iowa number. It's very similar to that. Same with soybeans. It's been running probably in that, you can see, again, yield is a factor in there. But depending where you get, you're 10 and a quarter to $11 a bushel. So, and I usually say to cover costs, that's what you need, probably Again, probably around $4.50 to $5 a bushel, depending on the operator, and 10.5 to 11 for soybeans. And so in the last couple of years, we haven't had a lot of marketing opportunities to get to those numbers. This, again, is from that farm management. I like to look at farm management numbers, especially when it's 1,500 farmers. This just shows in the last 10 years, not counting 25, obviously, because we don't have all the data in yet, but you can see the yellow line is the average of all those 1,500 farmers. The green line is the top 20% profit farms, and the red line is the bottom 20%. And you can see the bottom 20% don't show a lot of profit. Even some of the best years are 2021, 22, and the good high profit farms are really capitalized. Now, this is owned and rented farms, and certainly that can make a big difference in those numbers. This is a metric, and I throw this one in here because this is what a lot of ag lenders use. Dr. David Cole from Virginia Tech put this out a few years ago. A lot of ag lenders like to look at this, and there's all kinds of ratios when you get a cash flow on there. And I'm not going to go through them all, but there's a few I want to go. And basically what they look at is obviously your cold green, if those ratios are in those kind of numbers, they just kind of move on. If they're in code yellow, they start to look, hey, we better have a little talk here, figure some things out. Code red is where they have to make some adjustments a lot of times in a farm operation. And the ones I'm going to focus on here are the working capital to gross revenue. When that gets down below 15%, that's a challenge. Operating expense revenue to revenue, when that's over 80%, and the coverage ratio, when that drops, especially when that drops down around 110% or lower. Let's look at this operating expense ratio. That's one when I was an ag lender, I used to really pay attention to. Again, when that kind of gets up there in that 80% range or above, that's kind of a red flag to me. And you can see, and again, I like to look at the yellow line. The average there crept in the last couple 3 years has crept up into the mid 80s and kind of heading up toward 90%. That is a concern. Even the green line is getting up close to 80% on those higher profit farms, and obviously the ones that have some challenges are up near 100%. The other one is debt coverage ratio, and what this means is the ability where you got cash available to be able to make those term loan payments, whether it's on machinery or land. And again, if that gets below 0, obviously, or gets below 1, that's where you have a challenge. 1 means you're able to cover it. If it's 1.1 or 1.2, it means you got a 10% margin, 20% margin. Like I said, on David Cole's chart, he had 1.25. I think most lenders are probably comfortable if they can stay in that, 1.1 to 1.2 range. But you can see 2024 was the first time since 2018, and actually probably since 16 that the yellow bar there drops just slightly below that 1-to-1 ratio. And so that's a concern when you have to start. And basically what that kind of tells you is on the average, there were farmers that weren't able to cover their operating expenses. And when you have to start refinancing operating loans from one year to the next, that's when you start to get some challenges, because now you probably have to put some land up or other assets to help finance the operation of the farm. In other words, your annual inputs and that type of thing. So that's one to watch, and I'm hearing some of that going on right now from different ag lenders. As I look at cash flow trends as we go ahead for the next year, I guess the positives I don't see anything that's going to mess up the livestock profitability, especially cattle. Hogs are doing well. The one thing when you have low grain prices, corn and soybeans, The biggest cost in livestock production, especially fed livestock, is feed cost. And that when that feed cost is low, that certainly helps. I think there is a little optimism right now for crop prices, especially soybeans. However, we still have to make sure that China actually buys the soybeans and these other trade deals come through. As we've seen with the federal government, the situation we're in now, things can change like the wind changing or the weather changing from day to day and week to week. So we'll have to wait and see what happens there. I think we've seen some moderation in interest rates, might get another change there. Land values have stayed strong. That certainly is the underpinning of farm operations. If they have quite a bit of asset value in the land, that keeps the operation, the overall financial strength of a farm operation. And we're going to get more government assistance again. Right now we're in the second phase of disaster payments from 23-24. There'll probably be another economic assistance payments. And I'll talk briefly about the One Big Beautiful Bill, but that adds a better safety net. And as I've mentioned, the new trade agreement with China. The biggest concerns we have, I think, is continued challenging market prices. I think hopefully we'll get some upswing here in the next few months, maybe to market some of last year's crop. Farm expenses are not easing. And when I say farm expenses, I talked about seed, fertilizer, chemicals. The other thing that's really come up are things like repairs and machinery costs and parts and labor and those kind of costs. We are not seeing any reductions in cash rental rates. Most landlords are holding their rental rates steady. Normally, when you get 3-4 years in a row of a downturn, you see some drop in rental rates. Maybe there's some decline on the real high ones, but most of them are staying up there and probably above break even for a lot of producers. The tight profit margins, I think, will continue. That working capital, as lenders, we preached a lot back in that 2015 to 2020 era to save your cash, have some working capital. A lot of farmers did that coming out of 22, but in the last 2-3 years, they pretty well burned through a lot of that. And then just the whole uncertainty in Washington, D.C. I mentioned earlier, I think that's always a concern out there. One Big Beautiful Bill, again, I'm not going to go through all the specifics here. I would in a presentation if I were to do one on farm programs. But you can see there the statutory reference prices for corn up from $3.70 to $4.10. And if you go down to soybeans, from $8.40 to $10, wheat from $5.50 to $6.35. And that sets your base where your support prices are. We actually have better prices than that. The other big one on there is for 2025, farmers get the better of Ark County or PLC, whatever they've signed up for. And so that puts a lot better safety net in for the 2025 crop. Also, One Big Beautiful Bill, enhanced crop insurance. Again, most farmers are probably carrying 75 to 85% coverage. You can see the 80 and 85%, they up the federal subsidy 3%, which certainly helps. They all
Looks like Kent froze up here. I know he was about wrapping it up. It looks like he froze up there, but that was very informal. That was very awesome. So what we're gonna do real quick, thank you so much, Kent and Dan, for that wonderful presentation. We will now move to our QA section for the next 10-15 minutes. We'll discontinue the recording at this time and encourage you to take this time to ask the experts your questions. We will answer the questions in that chat that came through during the training. And if you held on to any questions, please raise your hand or unmute to ask your questions. If you think of a question